So sales minus $1,000,002 gives us a gross profit of $600,000. All right. So if we take the $600,000 and put it over the $1,008,000, that will give us a gross profit percentage of roughly 1/3. All right, now let's see what we had here. Let's get our cash collections of the principal in 2008. Now, our cash collections of the principal are what? All right, it says here, Drew paid $300,000 in cash on 2007. We don't care about that. And also, on December 31st, 2008, Drew paid $300,000 in principal and $150 in interest. Now we want 2008. So we'll take the $300,000 in principal that was paid in 2008, and we're going to multiply that by the fraction of 1/3, because the gross profit is 1/3 of every dollar. So our realized gross profit is $100,000. Now, what about the interest income? All right, whatever is earned in interest is earned in full. Don't apply this formula to the interest. So what's the total interest at December 31st, 2008? It is $150. So the total income earned, realized, and interest is $250. All right, my answer there is A. 58 is A. All right, now a few theory questions. For financial statement purposes, number 60, the installment method of accounting may be used when, all right? You always use the installment accounting method when the ultimate amount collectible is indeterminable. If you can't determine the collectability of your receivables, you will use the installment method of accounting. So that's C. Now 61, according to the installment method of accounting, gross profit on an installment sale is recognized in income when, all right? In what? In proportion to cash collections. We take the cash collections times the gross profit percentage, and that will be our realized gross profit. All right? So the answer there is C for 61. Now, 62. Income recognized using the installment method of accounting generally equals cash collected multiplied by what? The gross profit percentage. Letter C. All right? Now, there's another method called the cost recovery method. Now, under this method, once again, you will use it when you can't determine the collectability of your receivables. Now, under the cost recovery method, unlike the installment sales method, we recognize income after we collect the recovery of our cost. Now, let me show you what we're doing here. Let's look at 64. The following information pertains to the sale of real estate by Ryan to Sud on December 31st, 2007. Now, the carrying amount is $2 million. The selling price, cash, purchase money mortgage, $302,700,000, equaling $3 million. The mortgage is payable in 9 annual installments of $300,000 beginning December 31st of 2008, plus interest of 10%. The December 31st, 2008 installment was paid as scheduled, together with interest of $270,000. Ryan uses the cost recovery method to account for the sale. How much of the income should Ryan recognize in 2008 from the real estate sale and financing? All right, now, let's look at what we have here. The cost of the sale is $2 million. Now, we have to look at everything we collected. Once we've collected $2 million, then every dollar over that is revenue. All right, now, what did we collect? Well, we collected $300,000 in the sale price at 12/31/07. All right, now what else did we collect? All right, we collected the December 31st installment, all right, plus interest of 10%. All right, now, therefore, we collected at 12/31/08 $300,000 plus 10% interest, which is $270,000. Now notice, we don't show interest income, all right, when we use the cost recovery method. Interest income is just added to the cash to determine recovery of costs. So there's no interest income under the cost recovery method. All right, so what did we recover by December 31st, 08? We recovered, all right, 870,000, all right, of the 2 million. So therefore, we still have to recover the difference before we recognize any revenue, all right? So therefore, our answer is 0 for 64. 0 for 64. Now, let's look at 66. According to the cost recovery method of accounting, gross profit on an installment sale is recognized in income after cash collections equal cost of sales have been received. That is the answer, isn't it? Letter A. All right. In proportion to cash sales, in proportion to cash collections, that would be what? The installment sales method. All right. Now, let's look at the last topic, which are franchises. Franchises. Now, if I sell a franchise, all right, generally, I, as the franchisor, have to give you different services. And I'll only recognize revenue when I actually perform some of those services. For those services that have not performed yet, but have to be performed in the future, they're shown as unearned revenue. Now let's look at 68. Each of Potter Pie 21 new franchises contracted to pay an initial franchise fee of $30,000. By December 31st, 08, each franchisee has paid a non-refundable $10,000 fee and a signed note to pay $10,000 principal plus the rate of interest at December 31st, 09 and December 31st, 010. Experience indicates that one franchise will default on the additional payments. Services for the initial fee will be performed in 09. All right? So therefore, for the initial fee, we're not going to start earning that until what? 09 thereafter. So what amount of net unearned franchise fee, all right, would they report at December 31st, 08 as unearned? All right? Now what do we have here? We have, all right, we have here how many franchises are going to pay us? Well, we sold 21, all right, and we're supposed to collect $30,000. So we got 30,000 times 21. All right. So therefore, all right, we're going to ultimately collect 630,000. However, one franchise is going to fail. All right. Now, remember, the fee is 30,000, and including that $30,000 fee is a $10,000, all right, non-refundable fee. All right. So really, the fee, all right, that has to be returned is what? $20,000. All right? We're not going to collect, I don't want to say returned, we're not going to collect $20,000. All right? So therefore, one will not pay $20,000. So therefore, potentially, we're going to collect $610,000. Now, what does it say here? It says that experience indicates one franchise will default on the additional payments. All right, services for the initial fee will be performed in 09. All right. Now remember, the fee is $30,000. 10 is non-refundable, so that's automatically earned. Now, what happens to, all right? What happens to the other amounts? All right. Well, please note, the other amounts, all right, will not start being earned until 09. Isn't that correct? So therefore, December 31st, 08, what do we know? 610,000 is going to have to be shown as unearned revenue. Unearned revenue. All right? Now, let's look at multiple choice number 67. On December 31st, 08, Rice authorized Graff to operate as a franchisee for an initial franchise fee of $150. Of this amount, $60,000 was received upon signing the agreement, and the balance represented a note which is due in 3 annual payments of $30,000 beginning December 31st, 09. The present value of those notes at 12/31/08 is $72,000. According to the agreement, the non-refundable down payment represents a fair value of the services already performed by Rice. Let me see that. However, substantial future services are required of Rice. Collectability of the note is reasonably certain. In December 31st, 08, balance sheet, the unearned franchise fee from Grass franchise should be what? Now, remember, all right, they've already earned $150,000. All right, it says here, they were authorized to operate for initial franchise fee of $150. All right, I didn't say they earned the $150. Of this amount, $60 was received. All right, and the balance is payable in 3 payments, 3 installments of $30,000 each year. All right, beginning December 31st of 2009. Now, please note, the $90,000. All right, here we have we got $60,000 upon the signing. All right, and remember, all right, that $60,000 is earned because we don't have to perform any future services for that. However, for the balance of $90,000, which is 3 payments of $30,000, all right, we still have to perform services. So therefore, this is the way you record the unearned franchise fees. All right, you take the present value of the 3 $30,000 amounts. All right, so what you do is you debit notes receivable for the gross amount of $90,000. Now, we're going to credit unearned revenue for the present value of those 3 payments that are owed to us. And what are they? The present value is $72,000. And then we're going to show for the difference a discount on notes receivable of $18,000. Now, remember, unearned revenue is always shown at the present value of future payments. The note receivable is at the gross amount. So therefore, when you present the balance sheet, you're going to show notes receivable of $90,000 less the discount of $18,000, and there's your owed $72,000, which is the unearned revenue. Now, what are you going to have to do? All right, this discount represents future interest income. So what you're going to have to do is do an amortization schedule, all right, which will show an opening note receivable balance of $72,000. All right, you do an amortization schedule. Cash, all right, interest income, principal, balance. All right, and you'll start with the balance of $72,000. Now, this interest income, all right, will be the rate that you use to calculate the present value times $72,000. All right, let's assume that's, all right, $7,000. All right, I multiply, all right, the rate that I used to calculate the present value by $72,000, and that's $7,000. Now the difference, all right, remember, we'll make a $30,000 payment. So therefore, the principal reduction is $23,000. There's your 30, all right, and the cash collected would be $30,000. All right, so what I would then do is, next period, I would subtract the $23,000, all right, whatever that balance is, I multiply it by the interest rate, that's my interest income, subtract from my cash collection of 30, and the difference is the reduction of the principal. All right? So anyway, that's the way that works. So therefore, please go over the multiple choice that I suggested. All right? In fact, just go over the questions that I did. Now, in addition, all right, let me just give you a couple of other questions that I want you to do. All right? I want you to do multiple choice number 45, 46, all right, I think that will do it, okay? All right, so anyway, that covers accrual accounting and installment sales, all right? Make sure you know those installment sales formulas, all right? Cash collections times gross profit percentage equals realized gross profit. Ending receivables times gross profit percentage is deferred gross profit, okay? All right, make sure you know that installment sales, all right? And I went over basic accrual accounting, okay? All right, thank you. If there's any questions, call me on the instructor hotline. Please don't email me, okay? Call me 7 days a week, and I'll answer your questions on this Module 7a, all right, starting on my part, which begins with multiple choice 31. And don't forget, do all the multiple choice that I went over, plus the additional ones I gave you. Thank you, and we'll see you soon.